I'm not convinced that, VCs of the past were frankly more than anything but just lucky. And I wanted to really unpack that. And I think they were mostly lucky because it was a small number of people allocating a huge amount of money to a small number of companies. And so the odds of winning were just so good. And again, the market beta was just so ferociously amazing.
When people hear the phrase venture capital, some ask, wait a minute, what is venture capital? Others who are more versed in finance or fih-nance.
She didn't know anything at that point about finance, but she got stuck with managing the financial crisis for Europe.
Ask, wait a minute, what is really going on here? Let's tackle the first question. Venture capital basically means that you take the capital of your LPs, your limited partners, i.e. extremely rich families, sovereign wealth funds, corporate pension funds, endowments, etc., and invest it into early stage businesses in exchange for equity, i.e. an ownership stake in those businesses. You charge your limited partners a fee for managing their money. This fee model is generally 2 and 20, so you get 2% of the assets under management, the AUM, annually, and 20% of the profits, otherwise known as the carry, on your investments. We'll go over fees in more detail later in the video, as this is a very important piece to understand. We also need to understand some jargon, specifically the funding rounds. We have the seed round, followed by the Series A round, followed by the Series B round, followed by the Series C round, and some companies can go on to Series D and even Series E rounds of funding. An IPO can be like hitting the jackpot for early VCs. This is when they often join the ranks of the super rich. Now, let's tackle the second question.
We are, make no mistake, well, you are, I'm out, because I sold, but you guys are in the middle of an enormous multivariate kind of Ponzi scheme.
Here's how it works. Step 1, superficial growth.
It would probably shock you to know that almost 40 cents of every venture dollar right now goes right back into the hands of Google, Facebook, and Amazon. What do you think is happening there? You think that's all profitable growth? No. That's there to fund your superficial growth.
Step 2, raise a Series B round.
Then what do? They turn around to their buddies and say, look at this thing, it's growing. You should do the B. And then they come into a board meeting, they're like, guys, I think we should raise a B.
Step 3, more superficial growth.
So then, they're like, hey, you should raise a B. And some different firm, of which they're all buddies, do the B. Mark it up 4 or 5x. Now what's happened? Fund A, their returns look genius. Now it's all on paper, but it looks amazing, right? Fund B comes into the board meeting now. Hey, how fast are you growing? You got to grow faster.
Step 4, raise a Series C round.
And then the Series B investor says, we should raise a Series C. We're running out of money. Well, of course you are, because 40 cents of every dollar just went back into the hands of Facebook, Google, and Amazon. They introduce it to another buddy. That buddy is like, yeah, this looks great. Boom, fire the money in. Now A has an even better markup. B has a markup. C has a basis and is like, hey, how fast are you growing? Maybe you should grow faster.
Step 5, the firm who invested in the Series A round raises a new fund.
Now, meanwhile, somewhere between the B and the C round, the guy who runs Fund A is like, I should raise a second fund. I'm pretty good at this. And goes to a bunch of investors and says, look at my IRR. They're amazing. Isn't this amazing? And the investors are like, yeah, this is amazing. Here's more money.
Step 6, the firm who invested in the Series B round raises a new fund.
And then somewhere between the C and the D, the B guys are like, I'm pretty good at this. This is easier than I should raise a second fund. Maybe I'll make it a slightly bigger fund. I should be doing bigger checks. Raises a B, right? Raises Fund 2. Finds Fund A's batch of second companies and says, hey, let's work together again. We are good at this together. On and on down the line. This is what's happening now.
But what is the endgame? Well, fees. Specifically, it is the management fees that are a guaranteed cash cow. When saying the VC firm raises a new fund, this means that they are locking in another batch of LPs' money for 10 years this is the typical length of a fund. To clarify, the 2% fee is cash compensation paid annually regardless of the investment activity or performance of the VC firm. This fixed 2% fee structure obviously creates the incentive to accumulate and manage more assets. The larger the fund, the larger the fee stream. Let's look at an example. For a $1 billion fund over a typical 10-year time frame, what are the management fees collected? Well, 2% annually, i.e. $20 million annually, or $200 million over the full duration of the fund. Sure, some of that covers operating expenses, but a lot of it ends up with the partners at the head of the firm. In all but the smallest funds, the partners make high 6 and more often 7 figures in fixed cash compensation. As we touched on earlier, the carry, the 20% of profits if it goes well, can make these partners extremely rich on IPO. However, the dirty secret in venture capital is that the guaranteed fees are the guaranteed cash cow.
That whole industry that services you guys, theoretically services you guys, are no longer about your success because your success is about their carry and they couldn't give a fuck. They care about fees.
According to the Bureau of Labor Statistics, the median wage of US workers is just under $50,000 per year. This means that the average partner at a reasonably sized VC firm is earning roughly 20 times the average annual salary of an average American worker on just the management fee from raising a single fund without investing a single dollar. A study by Harvard and Yale researchers found that VC's abilities to pick investments and nurture startups play little role, if any, in long-term outperformance. The authors analysed decades of portfolio investment and performance data to assess the mechanisms of venture capital success. They found that investing in the right companies at the right time gives VC firms access to better deals, which often leads to long-term outperformance. And picking those original winners appears to be a matter of luck. Overall, it seems Chamath's initial assessment was spot on.
And I think they were mostly lucky.
What are your thoughts? Is it true or false? For more compounded valuable content, subscribe and like.